Somewhere in Australia right now, someone is sitting across from a financial advisor. They are 54 years old. They have worked their whole life, and they have just been shown a projection of what their superannuation will look like at retirement. The number is $210,000. The benchmark for a comfortable retirement is $595,000. The gap is $385,000. And the advisor is explaining calmly, professionally, that if they had understood one simple rule about superannuation 10 years earlier and acted on it, that gap would not exist. The rule did not require a high income. It did not require financial expertise. It required understanding one thing about how $10,000 voluntarily added to super at the right time behaves differently from $10,000 sitting in a savings account and then doing it. Most Australians have never heard this rule explained clearly. Most of the ones who have heard of it have never acted on it, and the cost of that inaction compounds silently for decades until the projection lands on the table and the numbers do not add up. This video is that explanation. Let's get into it. The $10,000 super rule is this. Every voluntary dollar you contribute to superannuation is not just saved, it is transformed. It enters a tax advantage structure where it compounds at a rate that your regular savings account cannot replicate. And the earlier you add it, the more dramatically it multiplies. Here's the math that most Australians never see. $10,000 contributed to super at age 30, growing at 8% per year, becomes approximately $160,000 by the time you reach 67. The same $10,000 contributed at age 40 becomes $74,000. The same $10,000 contributed at age 50 becomes $34,000. Same money, same return. The only variable is time. Over decades, inside a structure that protects your returns from being eaten by tax. And here's the part that makes this genuinely powerful. When you contribute that $10,000 to super as a concessional or salary sacrifice contribution, it is taxed at only 15%. If your marginal tax rate is 32.5%, which applies to anyone earning between $45,000 and $135,000 in Australia, that $10,000 contribution effectively costs you around $8,500 out of pocket. You put in $8,500, super receives $10,000, it then compounds for 30 years. That is a 17.6% instant return before compounding has touched it once. Most Australians are leaving this on the table every single year. Now let's talk about the darkest version of this rule. What happens when $10,000 leaves super instead of entering it? During the COVID-19 pandemic in 2020 and 2021, the Australian government allowed early access to superannuation. Over 3 million Australians withdrew up to $10,000, and many withdrew the full amount twice, accessing $20,000 total. Many of them needed it, genuinely needed it. Mortgages, rent, groceries, these were real pressures, and the scheme provided real relief. But here's what most people were never clearly told at the time. A 25-year-old who withdrew $10,000 from super in 2020 did not lose $10,000. They lost approximately $160,000 to $180,000 from their retirement balance, because that is what $10,000 in super at 25% becomes by 67% at average market returns. 3 million Australians, many of them in their 20s and 30s, each one making a reasonable short-term decision that carried a long-term cost most of them still do not fully understand. The $10,000 rule works in both directions. It multiplies what you add, and it permanently removes what you withdraw, not by $10,000, but by everything that $10,000 would have compounded into. Here's the part of this video that will genuinely surprise most people watching. If your super balance is below $500,000, which covers the vast majority of working Australians who are allowed to carry forward any unused concessional contribution cap from the previous 5 financial years and use it in a single year, the annual concessional contribution cap is $30,000. Have you only had employer contributions going in for the past 5 years, say $10,000 per year? You have $100,000 of unused cap space sitting available right now. You could, in a single financial year, contribute a lump sum of up to $130,000 into super as a concessional contribution, all taxed at 15%, and massively accelerate a balance that has been growing too slowly. Most Australians do not know this exists. The ATO tracks unused cap amounts automatically. You can see them inside MyGov. And a financial advisor or accountant can help you structure a contribution that uses this rule legally and strategically. This is not a loophole. This is a feature of the Australian super system specifically designed to help people who had career interruptions, periods of lower income, or time out of the workforce catch up on the contributions they missed. It is available. Most people never use it. So who uses the $10,000 rule and who doesn't? It is not about income. There are people earning $150,000 a year who have never made a voluntary super contribution. And there are people earning $65,000 whose salary sacrificed $200 a fortnight and will retire comfortably. The difference is almost always one thing: understanding that super is not just a retirement account. It is the most tax-efficient investment structure available to ordinary Australians, and every voluntary dollar added early is worth multiples of what it costs today. The people who get this act on it, they set up salary sacrifice through their employer, 5 minutes of paperwork, they check their carry-forward cap space each July. They treat voluntary super contributions with the same priority as paying down a credit card at 20% interest because the tax and compounding math is comparable. The people who don't get this keep meaning to look into it. They tell themselves they will contribute more when the mortgage is paid off, when the kids are through school, when things settle down, and then they sit across from a financial advisor at 54 looking at a $385,000 gap. Here's what all of this means in plain terms. You do not need to be wealthy to use the $10,000 super rule. You do not need to be an investor. You do not need to understand the stock market. You need to understand 3 things. 1, every voluntary dollar in super is taxed at 15% instead of your marginal rate. That is an instant return just from the tax structure. 2, money inside super compounds in a tax-advantaged environment for decades. Time is the most powerful variable. Earlier is always better than later. 3, if you have not been maximizing your contributions, the carry-forward rule means you may have years of unused cap space available right now. You can still make up ground. The gap between the average Australian retirement balance and a comfortable retirement is not explained by income. It is explained by whether people understood and acted on these 3 things early enough. Right, so here is your homework. This week, not next month, this week, log into MyGov and check 2 things: your current super balance and your unused concessional contribution cap from the last 5 years. If your balance is lower than it should be for your age and your unused cap is sitting there unspent, you now know what to do with that information. Talk to your employer about salary sacrifice. Talk to an accountant about a personal deductible contribution. Use the carry forward rule if it applies to you. And if you are in your 20s or 30s watching this, the $10,000 super rule is the most powerful financial tool you have access to right now. Not crypto, not individual stocks, not property speculation, voluntary superannuation contributions made early inside a low-fee, high-growth fund. It is boring, it is invisible, and it is the reason some Australians retire with real options while most do not. If this video helped you see your super differently, smash the like button and subscribe to the channel. Drop a comment below telling me what age you are and whether you have ever made a voluntary super contribution. I read every single one, and share this with one person in your life who needs to hear it, because the best time to understand this rule was 10 years ago, and the second best time is right now. See you in the next one.